Good evening, guys. I hope all of you are okay. And I hope you can hear me well. Kindly respond if you can hear me well.
Yes, you're audible enough.
Yes, audible.
So I'll go straight to my presentation. I hope all of you can see my screen. You can see my screen, huh?
Yes.
Okay, perfect. So I think most of us we know each other. We did introduction yesterday. So today I'll start with the introduction. Basically, terminologies, Forex terminologies, because most of the people who were here yesterday, they were that is the first time they were getting those new terms. And it's good for you to understand because in Forex that is a language, so you need to get familiar all these terms and how Forex works. Basically, definitions of most of the Forex terms and all that. So I'll go through the slides as you learn. So if you have any question, you'll just unmute, ask me, and then I can be able to answer. So nice.
Yes.
So,
Good. So what's Forex? I'll ask each one of you to that question. What is Forex? To your own terminology or how you understand Forex. Just in brief, I'll start with Ken. Ken Wonder. What is Forex to you?
I just think it is the exchange of currencies. Maybe as simple as for example, if I'm moving from here to America, I'll have to exchange my money from the Kenyan money to the US dollar. So it simply means that's the exchange of currencies, according to what I know.
Okay, good. Zoom user, to you, what is Forex?
it's trading of foreign currencies.
Dekure, what is Forex to you?
I think it's the exchange of cryptocurrency.
Good, even that is Forex. Maish, what is Forex to you?
It's buying and selling of currency.
Perfect. I've heard most of you have actually what is Forex. So Forex in short form is foreign exchange. It's also referred to just FX, which means an act of exchanging one currency against another at a given exchange rate, buying of one currency and selling of the other. It usually happens simultaneously. So if you want to travel to Tanzania, when you get to the border, I believe by then maybe you have your Kenyan shillings in cash or in M-Pesa. So you need to exchange our local currency to Tanzania because Tanzania they don't use Kenyan money. So most of the brokers they usually make money from the difference of the rates, the bid and the ask price. So most of the time they'll buy your currency at a cheaper price and sell to someone else expensive, and vice versa. That's how they are able to make their money from the exchange. Currencies are traded through a broker or dealer and are traded in pairs. For example, euro and US dollar. So anytime you're trading, you need to have two set of currencies. So mostly we call them pairs. So it's being paired with one currency with another currencies like euro USD. But most of us usually like giving it a short form. We just say EU. When you hear someone telling you EU, so they're trading euro against the USD. So euro is the bid price, and then USD is the ask price. So euro is what you have, and USD is what you want to buy. Or British pound and Japanese yen. Uh, Great Britain pound, that's for UK, and JPY, that is Japanese yen, the currency for Japan. Forex market is the largest, most popular financial market in the world. Um, if you put it in terms of volume, Forex market is the biggest financial institution that trades very big volume of money. So in the next slide, you'll see how much the volume is that is tradable on a daily basis. And that is the reason why most people um, involve themselves in trading because there's a lot of liquidity in that market. And if you do it well, you can be able to make a lot of money from that. Buying a currency is like buying a share in a particular economy. For example, when you buy, say, Japanese yen, you are in effect buying a share in Japanese economy. It's self-explanatory. Like if I'm trading GBP against JPY, so basically it means I have GBP, I want to buy JPY at specific price. And according to my technical or fundamental analysis, it will tell me if by that particular time I'll make money in future by either buying or selling. So it's just predicting the market with precision and historical data that you're able to analyze. So basically that's what is Forex. Unlike other financial markets, like maybe the Salam Stock Exchange, the Forex market has neither a physical location nor a central exchange. The Forex market is considered an over the counter OTC or interbank market due to the fact that the entire market is run electronically within a network of banks continuously over a 24 hours period. So basically, we usually say like the financial market runs for 24 hours. Um, but I beg to differ a bit because we have got three sessions. The Asian session that opens around 3, no, around 3 there to around 10. Then London session opens at 10. That's our time zone. Open from 10 to around 3, 4 there. And then there's New York session that open around 3:30 or 3. up to around 9 or 10, or even 11 or 12, around there. It depends with the time zone and all that. So most financial market, they usually close for an hour. So when it's midnight, they close, then they'll open at 1 the following day. So basically, we consider that as 24 hours economy in the financial market. All you need to get started is a computer, a tablet, a smartphone, internet connection, and knowledge on how to trade. That's what you're doing now. So the average trade volume in dollar, the Forex market trades 5.3 trillion per day. New York Stock Exchange, they do 22.4 billion. Tokyo Stock Exchange, they do 18.9 billion. And London Stock Exchange, they do 7.2 billion. So if you have ever heard of the business news, Fox News, business news, all these categories of stock exchange, they usually trade big volume of money, but none of them is compared to the volume that Forex market trades. It trades 5.3 trillion, way above the other stock exchange. Forex terminologies. So there are two types of forex. One, the offline forex. All of us, we know and we understand the forex bureau that are in town on wherever places. You go with your local currency, and then they give you any currency that you need. And then there's online forex that we are learning. So the exchange is done in online mode using computerized platform through forex broker. So for the online, you're supposed to have a forex broker for you to be able to participate in the market. But rather than on offline forex, you just need your cash. Go there, give them your cash, and then they'll be able to exchange for you any other currency that you need. Who are who trades forex? Here are 5 major forex market players participant. So I'm posing to you a question. Each one of you to name one participant that plays or take part in usually takes part in forex exchange, and what they usually, and at what scenario do they participate in forex exchange. Let's be quick. Maish, even I've given you answers 1 and 2. Maish,
Banks,
what do banks do? How do they participate? Okay. Ken, another participant in the forex market?
We have retail traders.
Who are?
Uh,
Yes.
like now we are like right now we are retail traders,
Thank
I
you.
guess.
Thank you. Zoom user, other participants? Dekure, other participant in the forex market?
Please pass me.
Sorry?
I said pass.
Okay. So who trades forex? Here are the 5 major forex market players or participants. The large banks. They are the largest bank in the world that determine the exchange rate. They are the one that makes the bid and the ask price. Those large banks collectively know as the interbank market. They make a number of forex transactions each day for both their customers and themselves. All of you knows most banks they make their money from foreign exchange. Basically, they do when they do transaction. When you want to send money from here, maybe to US, or someone is sending money from US to Kenya, you need to convert your dollar to Kenyan shillings, or vice versa. You need to convert your Kenyan shillings to dollar. That's how banks participate in forex trading. Commercial companies. These are like you see, like in Kenya, the UN Foundation and all that. Most of them are being sponsored by US government. So when they want to pay people who are working for UN in Kenya, they need to convert their US currency to the local currency for them to be able to pay their workers and all that. And these big commercial companies, they of course their workers are quite many, and their projects are quite many, so they have a lot of money. When they're doing any exchange, they can really make the market to move in very big pips if they're doing any exchange. Number three, government. Basically, government, they participate in this way. You see, like Kenya, we have borrowed some cash from China. So when we are repaying them their currencies, we need to convert our Kenyan shillings to their currency for us to be able to pay them. But most likely, most of the countries, they usually decide to use US dollar. So we need to convert our Kenyan shillings to dollar so that we can be able to repay our loan. That's how government participates in it. So for speculators, these are big players. We usually call them big boys. So then they usually do like they analyze the market fundamentally and anticipate, like maybe in the next few months we'll have a shortage of dollar, we'll have a shortage of Japanese yen. So they buy in big chunk as they wait for the market to hike in price, and then they sell, they make their money. So that's how speculators do. The retail traders, us, we are retail traders. We usually trade, some they do swing trading. You can hold a trade for a week or 2 weeks. You can do day trading like I usually do. Some can do scalping. You just scalp the market, few minutes, you're out. But I usually prefer to do day trading because you're able to catch big number of pips and you're able to make good money. So those are the five people who participate in forex trading: large banks, commercial companies, government, speculators, and retail traders. How forex trading works. Forex is so unique compared to any other business. If you're doing, for example, maybe you're selling tomatoes or oranges, you'll only make money when you buy low and sell on the, like you buy in bulk and then you come sell in small quantity. So basically you make money when you sell at a higher price. But forex trading works so unique in a way that you can be able to make money when the market is moving up, and you're able to make money when the market is moving down. So either direction, you are able to make money. So it depends with your strategy and how you know how to analyze the market. Because basically, this is how you explain, like you buy low and then you sell at a higher price, or you sell at a higher price and buy cheaper. That's how you make money in forex. So this is just a basic diagram that explains how forex trading works. As we are retail traders, so for us to be able to access the financial market, we need forex broker, and basically forex traders are liquidity providers. So they have all the currency in liquidity. So when you want to buy Japanese yen, when you want to buy US dollar, when you want to buy gold, they're able to provide for you that liquidity for you to be able to transact in the financial market. Without forex brokers, you can't be able to participate in forex trading. So they are very, very important players in forex trading. As for you to start forex trading, you only need a computer, a smartphone, or an iPad, a very good internet speed, a broker account, starting capital, and knowledge of currency market. And I think most of us we do have a laptop, or you can get a laptop, a smartphone, internet, and all that. So we only need to acquire this knowledge for us to be able to make good money in forex trading. Just a minute. Oh, there's someone waiting in the room. Okay. In the financial market, there are different sessions that we participate. You don't trade anytime that you want. And like for myself, I do trade a Tokyo session because I've major in gold. So I do participate in Tokyo session and New York session. These two works very well with gold. I've backtested it for quite some time, and I've seen it to works very well with my pair. So the hours at which each market session open and close in East Africa time. This is East Africa time. So one the Sydney session that open at 1 a.m. to 9 a.m. The best pair to trade is Audi NZD. There's Tokyo session that opens at 2 a.m. and closes at 10 a.m. The best pairs to trade is JPY and CHF. Then London session is 10 a.m. This is when you guys are waking up. 10 a.m. to 6 p.m. The best pairs to trade is Euro and GBP. And then New York session opens at 3 p.m. and closes at 11 p.m. The best pair to trade is USD and CAD. So this means any pair, because we have agreed for you to be able to trade, you need to trade a pair, the bid and the ask. So any pair that has Audi or has NZD, you trade it at this particular time. Any pair that has got JPY or CHF, you trade it at this time. Any pair that has Euro or GBP. So let me just show you an example of how these pairs are. let's do like Forex. You see every pair, every currency is paired with another one. Like USD, JPY, Euro USD, Euro USD, GBP USD, all these. So when they are saying you trade like Audi and ZD, so when you come here, search any pair that has AUD. So you search AUD. So all these pairs you can trade at that particular time. Audi USD, Audi JPY, Audi card. So there are so many. So any currency that has a quote or base currency of that particular pair. So that's how you trade those currencies. So market session, you'll say therefore the Sydney, Tokyo, London, and they have gone through all of them. So one terminology for in forex trading is exchange rate, and I've explained how exchange rate works. It's just the difference between the buying and the selling price of any currency pair. That is the exchange rate. So that's the example. When you go to any bank, they usually tell you like USD card. So they'll tell you 1.0. So you need this amount of USD to be able to buy this amount of card. So that's how they're able to make their money. So exchange. Someone asked me what is a pip. This is how you calculate pips. Like for pair, there are different kind of pairs. Like JPY has got to do two decimal places. Like um uh XU, gold, silver, they have two pairs, and then other currency they have got four pairs. So any currency that has got four decimal places, so the third decimal places, that is a pip. The last one is the smallest unit, but most of the time we usually use pip to be able to calculate how far the market has moved. So pip is the short form for a percentage in points, which means the percentage of a cent in a given exchange. So you just need to understand pips. That's how you use to measure the movement of the market. This definition mingi I make sense sana. So you need to know how to calculate the pips. Consider the exchange rate like EU versus USD. So if I've said like the market has moved 5 pips, if the price was 1.16205, if it has moved 5 pips, so you just need to add to the fourth decimal place. So the new price will be 1.16255. So you just need, if it's 5 pips, we just put the 0.005. Those are 5 pips. So if the market has moved 15 pips, we just need to add 0.0015. So the new price will be 1.16355. That's how you calculate the pips. So calculating the pips, for example, the gold has got two decimal places. So that is the difference. That is the only difference. So for gold, if the price is 1275.46, if we say we add 5 pips, so we are adding 5 pips after the decimal place. So if I say like the market has moved 5 pips, I'll add to 4. So it will be 1275.96. So if it's 12 pips, I'll add here. So I'll just put a decimal and add 1.2. So it will be 1277.66. To subtract 4 pips, we just need to subtract from here. So it will be 1275.06. So that's how you calculate the pips. It's very important for you to learn how to calculate the pips. Because when you're trading by yourself, you need to calculate the stop loss and take profits. And the only way to calculate is by pips. So you need to understand how to calculate the pips. How do you make profits in Forex? I told you you can either make profits in buying or in selling. You don't need to go through all that. So another terminology is lot size. Lot size matters a lot, a lot, a lot. If you want to do very well in trading, you need to understand the lot size. Because in trading, I've ever had someone asking me, ati umekelea pesa ngapi? There's nothing like that. In Forex trading, we usually use lot sizes. So there are different kind of lot size. So there's standard lot, there's mini lot, and there's micro lot. I told you for you to be able to use a standard lot, you're supposed to have like 1M in your account for you to be able to use a one standard lot. So I'll go to the summary so that you understand. So the standard lot is 100,000 units. That's not very important. So the standard lot is one lot size. And one lot size means when the market moves 1 pip, it's $10. That's what you need to understand. In standard lot, when the market moves 1 pip, it's $10. So if the market moves 50 pips, that is $500. For mini lot size, it's 0.10. For you to be able to use mini lot size, you're supposed to have roughly 100,000 in your account. At least 100,000 for you to be able to use that lot size. So 1 pip, it's $1. If the market moves 50 pips, that is $50. And for the small account like 20K, 30K, we use micro lot. So that is 0.01 lot size. So that means 10 pips is equals to $1. So if the market moves 50 pips, you make $5. So what you need to understand here is standard lot is 1, mini lot is 0.1, micro lot is 0.01. And the representation in pips and dollar value. Guys, I hope sikimbii sana ama nakimbia?
Uko sawa.
Niko sawa? Wengine niko sawa?
Yep.
Yes.
Niko sawa? Mnaelewa? Thank you. So leverage. I guess all of you mmesikia leverage. Leverage is so awesome, and leverage as well is not good. It's a double-sided sword. Leverage means the broker is able to lend you extra money for you to be able to hold a bigger position. If your leverage is 1 to 1,000, if you have $100. That means $100 times 1,000. So at the end of the day, it means you've got $100,000 position, worth of position. But this is a catch. Anytime the trade is going against you, the broker, they won't allow them to lose their money. They'll close up your position. So anytime I'll advise you, never go with broker that offers very big leverage. I've ever done that mistake when I remember the first time I started trading. I used to use the broker called I think XM or something. They used to give leverage up to 1 to 2,000. So you really enjoy when you make money. Like uh, you can be able to take a good position as so long as the market is moving on your direction. If the market goes against the direction, I remember I lost like I think it was 70 or 80,000 within 3 minutes. It was news time where I was almost faint that time. So kindly, and the regulation in Kenya, most brokers they're allowed to do 1 to 400, and 1 to 400 it's okay. That's very okay. The broker I really recommend to you guys is HFM, and the leverage is 1 to 400, and 1 to 400 it's very okay for anyone who is starting forex trading. But with time you can, wakati umeiva, you can do 1 to 2,000 leverage for those A plus setup. So long as the market is moving on your direction, you can open as many trades as you can, so long as the leverage is okay. I hope mumeelewa about leverage. The balance. Basically, balance, this is the actual amount of money in your trading account. So I'll show you, I'll explain the difference. So the difference between balance, equity, and free margin. Balance is the actual amount, which basically means your starting capital. So when you have entered a trade and you are maybe in 100 or even $20 profit, the balance will remain 500, but the equity amount is the balance plus the profit, or the balance minus the loss. So that's what is equity. So when you close your trade, balance and equity usually balances. So free margin, this basically this how long or how short your trade can be able to accommodate either losses. Basically it's losses. How long your loss can go. Because the smaller the free margin, that means the market, if you have a drawdown, it can hold a very big drawdown. So you really need to check on that when you're entering any trade. So the margin percentage, they just calculate from the free margin and the margin. They're able to get the free margin. So that's equity when you have got a loss of negative 1.24. So the balance remains the same, but equity reduces because of the loss. And even the free margin reduces because of the margin level. So I've explained the margin. Entry and exit, I believe everyone knows. Entry, this is where you open a trade. And there are like three. There's market execution. There's you can place maybe a buy order, a limit order, and all that will define. And then exit, this is where you exit the market, like the specific price you exit the market. A long and short, long of course it's buy, short is selling. Bullish. Bullish, this when the market is moving uptrend. Bearish, this downtrend. Stop loss and take profits. Stop loss and take profits. These, to my words, I usually say it's automation. You automate your trades. When I've got drawdown, when you put a stop loss, your trade will not go uh, uh, past your stop loss. That's where the stop limit is. And take profits, this is where you set the market to automatically take your profit when you're in profits. So mostly with gold, I do 60 pips stop loss, and then take profits. The first take profit is 60 pips. The second take profit is 120 pips. Third take profit is 180 pips. Yeah. So when TP1 is it, you just need to break even and wait for the market to move to TP2 and TP3. The bid price and ask price. We've said bid price, this is the highest price that a buyer is willing to pay for the currency. And ask price, this is the lowest price as which a seller is willing to sell a currency. So the currency that you have is the bid, and then the currency that you want to buy is the ask. So the difference, the bid price and ask price. So the difference between the bid price and the ask price is the spread. And anytime you choose a broker, there's a way you can check the spreads. And spreads matters a lot. Let me show you where you can, these are criteria I use to choose brokers because spreads matters a lot. That's why sometimes you open a trade and then you find out you're already on negative because the spreads are so high for some of the brokers. That's another reason why I chose to trade with the HFM. These are the spreads for each and every company. You see, other brokers, the spread for like USD JPY is up to 0, that's very good brokers. There are some brokers where look like this one. Have a look at this. Azo Capital, the spreads are 2.7. That's too high, too high, too high. So when you're choosing a broker, you see this one with red. This is so dangerous. So you need to pay more when you're trading with them. At least Xness is 0 point something, but still it's too high. So you just need to go to my FX book. It's a free software, and then you go to spreads. So that will tell you which broker gives you what spread, and that will determine if you'll go with them or not. Sawa guys.
Yes.
Um Really, that software is a bit heavy. This one is a bit heavy. Okay, so let's go to next. Bid. I've told you what is bid price, what is ask price, and the spread. Nothing to discuss. Rollover and swap fee. So most of the brokers usually charge swap fee or roll over fee. These fees they usually charge you when they hold your position overnight. So when you're seeing trader, most like on my trading strategy, I don't experience such fee, the swap fees, because I don't hold my trade overnight. But if you're seeing trader, you are charged every overnight for a specific fee. Maybe it can be $3 or $5. So it depends. So if you decide to go with swing trading, whereby you hold your trade for like 2 weeks, 3 weeks, you're supposed to really research well for the broker that offer the lowest swap fee, so that you don't pay a lot for the overnight trades. Um, for us to be able to practice our skills that you have learned over time, it's advisable uh, to start with the demo account. Um, but I don't subscribe to that school of thought because trading is more of psychological and emotionally. So if you're trading without like demo, is not real money. So there's no emotional attachment to that money. So at the end of the day, that day you'll deposit the real money in your account. I believe that is the first time you'll start your experience with real trading. You'll have emotions with your capital. You'll have psychological issues. You can't hold trade for long. You don't want to see when there's drawdown. So I usually advise people, if you are, so long as you know to take trades, you know to put stop loss and all that, and you have a strategy, and you have dated it like for a week, just go with real money. The more you lose, the more you get it right. So that's my advice, but you can go with it or not. It depends with how your resilient is in the market. Why trade forex? One, volatility. We have seen the trade forex market transacts large sum amount of money in a day. So at no point you can go to the market and you don't find buyers or sellers. They're ever there. So the volatility it's so high. Accessibility 24/5. We trade from Monday to Friday, any day, any time. So long as you have a laptop, wherever, any place in the world, you can be able to access the financial market. Leverage. Very few businesses can be able to offer you a specific amount, maybe to do business with. They'll need collateral and all that. But in forex trading, they can. There's some brokers and most brokers they allow to give you leverage for you to be able to hold bigger position in the market. Low barriers, few entry requirements. When you register account, they just need your ID for government requirement and all that. The tax, your tax, whatever registration, and a few verification, and you're good to go. But other business, you need a lot. You need registration, whatever of the business, permit, and all that. For forex, you just need to open an account, and that is it. No commissions. Most brokers they don't charge commissions. They usually get their money from the difference between the bid and ask price. So that's where they make their money. Some brokers offer bonuses, like when you deposit like $100, they give you 100% bonus. So if you deposit 100, they give you 100. This is a catch. But when you're a newbies, you usually feel it's interesting for them to give you bonuses. But mind you, Trading is psychological. You see, when you have $200 in your account and $100 is bonus, that bonus can't hold your position if you're not drawdown. And you see, when you're on a trade, it's a bit hard for you to really determine how low. Maybe it's news time. You say, let me just remove the stop loss and see how low it will go. I've ever done that and I blew my account. I saw I had like $200 or I think it was 160. So literally, I only have $60 to hold that position. So I really advise bonuses. I don't use bonuses nowadays. With time, you'll understand. Yeah. Um, Currency pairs. We have talked about that. Type of currencies pairs. There are major currencies pairs. These are pairs that has USD in it, like USD JPY, Euro USD, GBP USD, USD CAD. Any pair that has USD, that is a major currency pair. And most people love to trade major currency because for major currency, it can make big moves within one day. But for my minor and cross currency, it's a bit tricky. Maybe you need to hold for 3 weeks or 2 weeks for it to make a very good move for you to make good money. All currency pairs that does not contain USD are considered as minor or cross pair, like CAD JPY, NZD JPY, Euro BBP. That's minor or cross currencies. Exotic currencies are any major currency that is paired with an emerging economy. Like if they pair like maybe South Africa rand with Kenyan shillings. That is called exotic. Most people they don't trade exotic currencies. Um, those are exotic currency as well. A broker, I've explained what is a broker to you guys. Now you understand what is a broker. Service offered by the broker, asset price chart. Some brokers they offer training, professional management of the accounts, information and news feeds. Yeah, most brokers they do that. Um, Type of forex brokers that's not really necessary. Factor to consider in selecting a forex broker: security. Um, the brokers because most of the brokers, uh, for you to consider a broker, most for those good brokers they usually have two authentication. You log in with a password and you need as well to key in the authentication code. So that's very very good security because if anyone gets access to your account they need the verification code for them to really access your account. Second is a spread. I told you you're supposed to check the spreads, and then transaction cost. Basically that means the spread, the difference between the bid and ask price, and then deposit and withdrawal. Uh, like HFM, they have M-Pesa. So you can deposit M-Pesa and you can withdraw with M-Pesa. It is instant. And they don't charge you to deposit, they don't charge you to withdraw. So that's another consideration of going with such broker. Trading platform. Um, Best brokers, they usually allow you to use MT4 and MT5. Execution of orders basically means the spreads and all that. When you're executing a trade, it needs to be instant, fast, has to be precise in the market. Good customer care service. If you have got an issue, you're able to call them, you're able to contact them, and they're able to sort you out. HFM is the best because you can call them anytime. If you have issue, they can really sort it out for you. Leverage and margin requirement. I've shown you where to check those ones. And the leverage, kindly use 1 to 400 and you check the margin. Available currency pairs. So when you are selecting the brokers, some brokers, they don't have like gold, they don't trade gold, they don't trade silver. So when you're selecting a broker, you're supposed to check if they have all that. So if they have gold, they have US 30, if they have cryptocurrency, those are the reasons to consider when you're choosing them. And then starting capital. That is key when you want to start this Forex trading journey. How to open a Forex trading account? Choose a broker. I'll give you the link to the broker. When you want to open an account, select the account type. We'll just select the normal one for a start. Then you register, activate, and all verification, and you're good to go. Yeah, that's the end of just introduction to Forex terminologies. Yeah, so you'll get conversant to all these terminologies. I'll share the. I'll share the. I'll upload it on YouTube, and then I'll give you the link if you're able to go through it and just read through it for you to be able to understand those terminology, because they're very, very important. So tomorrow we'll go through how to use TradeView, how to connect, how to register a broker. We'll do the demo accounts, how to link them, and how to use TradeView. That's what we'll do tomorrow.